Rents are tied to inflation as well. And so even when we have short-term fluctuations, rents really don't crash. They can fluctuate pretty hard sometimes, but like rents fluctuate for generally short period of time, and then they creep back up, and they tend to be pretty sticky over time, especially due to inflation. Now, we'll probably be back up to where we were post-COVID 6-12 months ago relatively quickly, I would think. Rents do not go through the same cycle that real estate prices potentially could. They fluctuate much quicker, right? A lot of that is just due to inventory demand, and every market is hyper-specific too, just based on their micro, macroeconomics in that area.
Today on the show, I have the pleasure of speaking with Zach Lemaster. Now, Zach started investing in real estate while working as an optometrist and the captain of the US Air Force. This eventually allowed him to retire from his career early in medicine to be a professional investor by strategically investing in markets that maximize cash flow, appreciation, and equity. I'm really pumped and excited to have him on the show today to share his incredible knowledge and his insight. But enough of me, let's get him out here. G'day, Zach. Welcome to the show. How you doing today, mate?
Hey, Reed, what an intro. Thanks, man. I'm excited to be here. Thanks for having me on.
Can you rewind the clock and tell me how you made your first ever dollar as a kid?
First dollar as a kid was selling gumballs. And I don't know if it's quite maybe $1. It was probably less than $1 then. But I mean, that's a unique question, Reed. But I would buy bulk gumballs, candy store, distribute them out to all the candy hungry kids. And I guess that was my first entrepreneurial endeavor.
The reason for that question, it helps really spark an intrigue and curiosity into your upbringing with financing.
Yes and no. I think that a lot of us that find ourselves in different facets of business, certainly in real estate, I think there's a certain level of this that's true for you as well, Reed. But coming into this industry from a completely different industry, right? And so, as you mentioned, my wife and I are both optometrists by education. We met in school. I was on scholarship with the Air Force, so I joined the Air Force after school and spent 7 years there practicing optometry. I read multiple books. I became obsessed with just kind of the financial independence movement, right? Not even that, just thinking how to think about money. I didn't come from money. My parents were blue collar. They were wonderful, fantastic. We didn't have a bad upbringing. I didn't come from poverty either, but like they just didn't really think about money. There's paycheck to paycheck. They were renters their entire lives. And I think I started to think about money appropriately just by looking at wealth. I was always interested in money. So I started to look at wealthy people and just kind of almost study them a little bit and pay attention to what they were doing. And that led me into thinking about real estate, to have an interest in real estate. And then, of course, I went down the Kiyosaki rabbit hole, as many people do, read the Purple Bible, as we call it, and then got a little bit into like, hey, real estate it seemed like a very simple thing for me. The math was simple. So I bought my first house, which was a duplex. When I was a young captain in the Air Force, I had the privilege of using a VA loan, so no money down. I didn't have any money, which is good. So bought a house, active, lived in half, rented out the other half. Thought, hey, this is pretty cool. Someone is paying for my mortgage, and I'm all buying an asset that I don't have to throw away money on rent, and I can grow its appreciation, right? Grow equity. And then the next year I did the same thing, and the next year the same thing. There was a pivotal moment in our investing. When I say our, my wife and I in our investing trajectory, where we started to look at areas, not just where we lived. We started locally because that's what we knew and what felt comfortable. But then we started to look at different locations around the US where we saw better opportunity. And that changed the trajectory of our investing because it allowed us to make the US our landscape and not just be hyper-focused where we were, and actually invest in areas that had better returns, better appreciation, fit our goals more. And that allowed us to retire from our career paths in optometry early in life and start rent to retirement, where we essentially help people do the same thing, simply because we had a lot of friends and family and colleagues, Reed, that came to us, said, hey, we see your success in real estate. We don't have the time, the energy, the knowledge to build these out-of-state teams. Can you help us, right? So that's a little bit of our story.
No, I love it. And just for those people who are not watching on YouTube, go check out this show on YouTube, because Zach has a great pair of glasses on being an optometrist. So I had to sort of just mention that. With that being said, let's dive into a little bit of what you do today, right? We mentioned in the green room, I know what you do, but for the listeners, what's the sort of business look like on rent to retirement?
So what we do, we are the nation's leading turnkey investment company. And I know that we talked a little bit about that as well, because turnkey is a broad word. There's a lot of people that operate under turnkey. There's no real clear definition of what that is. But what that means for us, Reed, is the first thing we do is we identify markets throughout the country that have viable investment fundamentals, areas, things like landlord-friendly legislation, low taxes, future population and economic growth, have affordability. We want to be below the median house price point in the US, which is 408,000. We want to be building and rehabbing houses much below that. So we have the highest tenant pool and buyer pool ultimately. But we essentially find areas that have good fundamentals. We go and build our teams and systems in those areas to essentially either rehab or build products. Majority of what we do is new construction. So we essentially build houses, lease and manage them for investors, allowing them to own rental real estate in some of these ideal locations without having to self-manage or build their own teams in these areas. In addition to that, we're not just selling a product to people of a newly built house that's leased and managed for them. We're helping them build a business plan and a strategy to ultimately, reach financial independence or whatever their goals are through real estate investing. Because the big difference, anyone can buy a handful of rentals. Very few people are financially independent through real estate. And so we try to bridge the gap of giving people actually a roadmap and a strategy on how to scale over time. That takes time, of course, but that's what turnkey means to us. And that's what our business does. Over last year, we did just under 1,000 doors across 12 different markets. That's mainly the Midwest and the Southeast, in areas where population is growing. We can have good cash flow numbers, good appreciation, and kind of meet the fundamentals that we talked about previously. So that's what our business looks like today.
That's awesome. And I think 12 different markets. Do you want to define what those markets are?
Two main geographic locations. And so we work in the Midwest and the Southeast. Midwest, we have a little bit of new construction in the Midwest, but Midwest is mainly your like $150,000, $200,000 B-class type of single family rental that was built in whatever, 1950, 1980. We rehab it, we place a tenant in. That's kind of what you think about with traditional turnkey, just bread and butter workforce housing. Majority of what we do in the Southeast, and those areas would be Missouri, Ohio. Like we worked a lot in secondary markets, like outside of Cleveland, areas like Canton, Akron, Barberton, areas that are just adjacent to larger metro areas where I think there's a lot of opportunity. So Indiana, Ohio, Missouri, that's our main Midwestern markets. And then the Southeast is where we do all new construction. I know that you and I both operate in Texas. Alabama is one of our biggest markets, Carolinas, and then Florida is probably our biggest market compared with Alabama. So those are the areas we focus on.
Gotcha. Talk to me a little bit about the transition from buying existing property to doing new property, and maybe a little bit around, I just know I've been doing this podcast for going on, 9 years, and we've spoken to a lot of turnkey providers, a lot of international investors who do listen to this show come to the US because just the entry points are so much lower, particularly in those second and tertiary markets. And let's call a spade a spade. The word turnkey can sometimes have a dirty connotation to it because it's, people have been screwed. How do you like to make sure you're not screwing your tenant? Because you hear a lot about customers, hear a lot about people saying, I bought this turnkey property for $60,000, $70,000. It's not working. I'm not getting the response back from the management team. Maybe talk a little bit about how that has evolved the way your business operates from where you were when you probably started.
Certainly, yeah, we've seen that evolution. We've seen a lot of operators come and go. I've been in business for 10 years now, and our business has evolved over those years as well. But there's certainly no shortage of people out there. Just like any business, right? There's good operators and bad operators. There's good property managers. There's any business has that. But really, I mean, turnkey does have a sour taste in some people's mouth if they're one of these individuals that bought a low income property out of state. They never saw it. They maybe didn't go through normal due diligence. They just didn't really set their investors up for success. Now, usually those providers that would offer those properties, they're probably not around today. They probably had a few short years, and then reputation caught up with them. But I think the big difference there is that they focused on like low income areas. You can do, and some people really like Section 8 and do well with them, especially in large multifamily housing. That's not us. But I did have a short stint early on where, hey, it was attractive. You could go in and you could flip a low income house, right? And you could make 20 or 30K, sometimes more on it, place a tenant in there. And, it's kind of a little bit of a crapshoot. If the tenant stayed and paid rent on time, then the end buyer would have a successful investment. If they didn't, and that tenant trashed the place, or you had to turn that tenant 2 or 3 times, it was really a bad investment, right? And it was high risk. And then some people did things where they required you to buy cash without inspection. Obviously, I would never recommend that. But anyways, what we found, Reed, over time is that, man, I just like new construction because it's less of a pain in the ass, right?
Mm.
And it really, I think, sets people up for success long term because you're buying a brand new built house. You have builder warranties on things, so you don't have these unforeseen capital expenditures. You're attracting quality tenants because the rents are higher. You get a larger tenant pool. They're in growing areas where you have better appreciation both in rents and home prices over time. They're just more predictable. The challenge with new construction is that it tends to be a little bit more expensive, right? Like our average Midwestern house, because we'll still rehab, I don't know, 50 to 60 houses a year. And for those investors that want those areas, and we're really particular about the areas we focus on, vast majority is what we do is in new construction. But they're higher price points. Average Midwestern house could be $150,000, $200,000 house. New construction in the Southeast, average house price probably 300,000. But new construction, I mean, it's just way more predictable, and I think it truly sets people up for success, better success long term as you're in growing areas. That's our take on it.
Given my background in structural engineering and I've worked for big developers in the past, what are you doing from just the entitlement point of view? Like, are you finding land, tract maps of land to go and build new product, or are you just going in and finding the individual lot in a nice neighborhood and then building it that way?
Most of these are infill lots, especially in the Southeast. You just see a lot of them. We've done a couple small community development projects, but the majority of what we do is for ground up in particular, because we really have two models. We do ground up, which we're actually the developing land and building the properties, but we also buy from builders too. We were the largest buyer from D.R. Horton in Florida last year, who is the nation's largest builder. Simply because if we have investor demand for products, we can go in and inventory is available, which right now there is inventory availability. We can go in and actually negotiate like wholesale type prices like an institutional buyer would, and then set individual investors up with those where they wouldn't have access to those deals on their own. So those are the two different models. But for the ground up construction stuff that we do is mainly infill lots. We like established communities in areas where the lot's already pre-parceled out. We did majority of our construction last year was Southwest Florida. Like Cape Coral, and you could pick up a lot for $20,000 to $30,000, build a $250,000 to $300,000 house. It's going to rent out from $2,300 a month in rent. Have 50 to 80K of equity when it's done, and just be a solid type of investment. So one other thing I want to mention too is we try to be creative working with our investors on how can you creatively scale over time. I'd mentioned that previously, and we really want to make our investors successful long term. For anyone, if you just Google myself or our company, we have an exceptional reputation that we've built, and this is why we're one of the players in the space that remains over the past decade. We have more 5-star reviews than any company out there, but in the turnkey space, that is. But we really like to help people use creative methods to scale. And this might be interesting to talk about, but we do have seller financing products available on interest-only loans. We have local credit unions we've developed relationships with that will finance our new construction properties. For investor products with as little as 5% down, you can buy multiple investment properties at 95% debt. You still have to qualify for those. There's all sorts of creative ways we help people as well get into these properties and actually scale their portfolio over time. And I think that gives us a unique niche in the space too.
I want to talk about the financing, but where I was actually wanting to go with this was in the construction and management space. Like, you hear a lot of complaints from clients who buy these turnkey properties of just trying to get attention from the turnkey provider. So how do you keep the management of not only the construction, but the property management post-closing across so many different markets?
Well, we don't do management first and foremost. So it's hyper local to each location. So we did manage at one point in time, and that is hats off to anyone who's running a real successful management business, because it is challenging. But our goal is to find local managerial teams that do well. And we have, of course, systems that we've developed over time that, screening tenants properly, that we can help these teams implement better systems if they need to. But generally speaking, we've done very good partnering with local property managers that are already existing in these areas and doing a good job. That also allows us to be a little bit impartial. I think there's sometimes, the argument could be made that there's a little bit of a conflict of interest with having management in-house where everything's just like under one roof, right? But at least with us, our goal is to make sure that management is doing their job so the investor is successful long-term, so they come back to buy with us. There's a reciprocal relationship there. We want them to be successful so they continue to invest with us. And by doing so, management needs to do their job. And also, if management's not doing their job, we can pivot them. We have multiple teams in each area that we have relationships with where, hey, they need to maintain a certain level of management experience. Otherwise, the guy down the street that is also doing a good job is going to get the business. And that allows us to be a little bit like arm's length for management and also make sure that the client's needs come first.
Yep. No, I think that's important. And I would also probably safe to say that you're going into new construction, right? So you're having less management headaches with new construction maybe versus that Section 8. And I'm not trying to stigma.
You're 100% correct.
Stigma on anyone, but like, you know what I mean? Like it's this newer construction. I've been in the business long enough. I've had my fair share of Section 8 housing. Like there's just going to be a lot more things managerially that you have to watch with a Section 8 house versus that one that is not. And then also the special sauce here, guys, is you buy a cheap house. And I know this. I'm giving the secrets away. You go buy a cheap house. You've got to fix the envelope, the HVAC, the foundations, so you don't have to keep coming back and keep putting more money into it over the years, and you can keep that cash flow in your pocket. New construction is the epitome of that. You've got builder warranties. You're literally building from brand new, so things don't fail. Like your HVAC system's not going to fail 2 years into a hold. They're the things you want to be able to mitigate against. And buying an existing asset, you can do that, but it just obviously takes cost on the front end. So going in eyes wide open on all those sort of things can really make or break an investment over the long term. What I'd love to talk to you about, Zach, is how you're seeing the industry change with these things you see on bigger pockets, the burst strategy, the 1% to 2% rule for rents. Have you seen the increase in interest rates over the last 18, 24 months affect the business today, affect rents, affect even DHR Horton's ability to build? Because I am hearing on the bigger side that these bigger companies are struggling a little bit to get rid of inventory. What's sort of the underlying sentiment right now in the sort of the single family space?
Is constant evolution, and every market cycle is different. Like we look at previous trends on our podcast, we were just looking at how an election year affects a market, and it's really interesting some of the data points we extrapolated out of that. But generally,
please share if you want.
Yeah, I will. Let me answer your question, and then these are my notes from our election year stuff, so we can go through some of that stuff. But and I'm actually presenting with Dave Myers on Bigger Pockets about this topic next week. But what we are seeing right now, because it's changing right now. So over the past 18, 24 months, we've had the highest increase in interest rates in the shortest period of time that we've seen in the past 40 years. Obviously is very aggressive, but that also means we're coming back out of a historically low, all-time low interest rate environment as well. And so that's obviously going to slow activity. There's a lot of people that thought, hey, the market was going to correct in a lot of areas. We all know that just due to inventory shortages, that didn't happen. But there was also stagnation in buyer activity in a lot of institutional buyers, which a lot of times, sometimes are our buyers or competitors, but they're scooping up a lot of single family houses and they take them off the market. You never see them again because they keep being traded up in funds, but they stopped buying in a lot of cases. And so what we've seen is there's just been a huge stagnation. A typical new construction, let's say on a typical market cycle, average market cycle, you'd see about 10% of the houses for sale or new construction. Right now, there's about 30%. Actually, it's less now. But what that means is there's a ton of inventory because builders, ourselves included, that have houses now and have over the past year or whatever, they started those houses a year prior to that, possibly longer. But they're still holding on to the inventory. But now we're starting to see what I just explained is probably true up until mid-January. So, a month and a half ago. Now what we're seeing is that inventory is starting to move much quicker. During this whole period of time, 6-month inventory would be considered a, even playing field between buyer and seller market. We still have less than 3-month inventory in most markets that we work in. And that's starting to go sway more towards a seller's type of market. There are more transactions happening and transactions are speeding up some. And so I think this is slightly election year, right? But also interest rates are starting to come down a little bit. People have been sitting on the sidelines for 2 years. We're starting to see more inventory move and things are starting to pick up, and construction stock costs are starting to go up again, and builders are starting to incrementally increase their price point. So all this being said, my prediction for the next year is that, we'll likely be well into a seller's market very quickly. I would say probably at least by Q3, early Q3 of this year, where prices will constantly go up consistently again, especially we have a slight reduction in interest rates. Even if we don't have that, I think it'll still happen. There's more buyer activity, more bidding wars out there. We're excited about 24 because we're already off to a record start, well above the past 2 years from where we've been in terms of home sales. So we're starting to see investors get in and make action. So I don't know if I just rambled on, Reed, with a bunch of nonsense for 5 minutes, but that's kind of what we're seeing. So
No, it's good. I think you're seeing the same thing across commercial real estate as well. Have you seen the reduction in house price like we've seen on the commercial side, particularly in multifamily?
no, we have not. Yeah, home prices, man. There's been most of the markets we've operated in have had still appreciation over the past 2 years. Now, albeit it's been much slower than what we would anticipate, prior to that, right? We just had that crazy appreciation run post COVID, but
So
no,
you didn't see people, it didn't come off that crazy post-COVID appreciation?
what has changed in some markets specifically is if rents have fluctuated a little bit. Rents have come down. In fact, here's an election stat. We looked at the past, so going back to 1996, every single year, every 4 years is election, right? So every single year, rents have increased during an election year by at least 4% on a national average. That's really big. There's not been a single election year in the past 32 years where rents have decreased. And this is something that we looked at, the year preceding and after as well, but mainly focused stats on that year. Over the past 6 to 8 months, we've seen probably about a 5 to 10% reduction in this is mainly like Southwest Florida is where we have a lot of our stuff. And I do think that's just because of an influx of all these builders at one point in time having inventory, that renters have more accessibility to the new construction because retail sales slowed a little bit. And that trend's starting to reverse a little bit. So we're back up on that. But no, we did not have a reduction in home prices. What we did do, though, is we offered more seller incentives, right? So we kept prices the same. We didn't see reductions in appraisals or home prices, but we paid more. We bought rates down. We bought blocks of rates so we could buy, like right now, we'll buy an interest rate down to 4.99 for a 30-year fixed loan for investors where we're paying all the points for them. So there's more incentives, free year property management, things like that. And that was pretty common. A lot of builders were spending more money to offer more incentives, I would say.
Well, one thing I want to add is that you mentioned the reduction and you said there hasn't been, in all the years of the election cycle coming up, the year of the election has gone up 4%. But I think you've got to layer on, which you mentioned, just so the listeners don't miss that. We had a crazy boom post-COVID in rents across the country, single family and commercial multifamily. Like we're talking some areas went up 20%, right? I've now seen the same thing. We've now seen it start to come back down and have negative rent growth. Doesn't mean it's going back to where it was, but we have seen negative rent growth. And I'm very interested to see how this year plays out, given the sort of the tailwind we had coming into this year. Does that 4% average still hold, or is this year an anomaly because of the huge rent growth we saw in the past 18 months? That is the only piece of grain of salt that I would be like, I'm interested to see how that, because in 2019, it was quite steady, chugging along, and then went boom. And then all of a sudden, now we're coming back down the other side. I think we've hit the sort of the floor again, and then we'll start slowly chugging back up again. But there has been a massive difference. And if you got into the market in the last couple of years thinking, oh my God, look how good these rents are, we're definitely seeing on some of our portfolio on the commercial side, those rents aren't being achieved like we used to see them. For 2 bedrooms, for 1 bedrooms, for studios, they have come off their sort of the heat. They've hit that ceiling. They've come back down. We're not back pre-COVID, but we're probably 10 to 15% off that peak that we saw, call it mid 2020, end of 2022, early 23.
Yeah, I would certainly agree with that. We've seen some of those reductions, and of course, like what the stats I was just talking about, the last one we ran was 2020, right? Last election. So I think this year will certainly be a little bit of an outlier and interesting to see where they actually play out. But I will also say this with rents in general, rents are tied to inflation as well. And so even when we have short-term fluctuations, rents really don't crash. I mean, they can fluctuate pretty hard sometimes, but like typically speaking, at least in our experience, rents fluctuate for generally short period of time, and then they creep back up, and they tend to be pretty sticky over time, especially due to inflation. Now, I think the reason why we're seeing the dip now is just for all the reasons you outlined, Reed. But I do think that we'll probably be back up to where we were pre or post-COVID, 6, 12 months ago, relatively quickly, I would think. Rents do not go through the same cycle that like real estate prices potentially could. They fluctuate much quicker, right? A lot of that is just due to inventory demand, and every market is hyper specific too, just based on their micro macroeconomics in that area. So.
No, we could talk a whole episode about this, because one of the things I will layer in there is that cap rates of commercial real estate, particularly multi, are tied to federal fund rates. And when you bought something at a 4% because the federal fund rates were at 3 or 2, now they're at 5.5, that cap rate's probably in the 6s, right? So your value of your asset has completely eroded, which we have seen in real time. But back to your point, we're seeing some challenges in the commercial multifamily real estate market right now. We think it's a bloody fantastic time to buy, but it's not a stock ticker, and you can't press the exit button if you're 2 years into an investment, and sometimes your investment's now come off the boil a bit because you bought it at 4, it's now worth a 6. Don't panic. Hold and let it normalize, I think is what you're trying to say. And that is and the normalization will be tied to rents as well, right? Because you value your asset based on how your rent growth is, and your NOI growth, but that's also tied to market capitalization. And one of the big things I'm trying to look for this year is not whether there's 4 cuts or 3 cuts or 6 cuts. Let's just get to the first cut, right? And I think that will give to some clarity between, the forest from the trees. Do we all now know what game we're playing? Because the last 2 years, there's been a lot of people on the sideline. It was what you've mentioned, what I've mentioned, is because no one has clarity. We don't know where we're going. We can all play in any interest environment, any interest rate environment we want as real estate investors. We just need to know the rules of the game we're playing by, and we still don't know where that's going. And I think an election year will add some uncertainty in the geopolitical sense that will also cause people to stay on the sidelines for a little bit longer. And I don't have the data to say this. I just know I've been through a few cycles being here for now over a decade, that you do some around the November timeframe, September, November, December of an election year, nothing's happening because people are waiting with bated breath to see who gets into office.
Well, and so the question would be though, Rita, like, would you recommend to people, because I have my thoughts on this, but I'm interested to hear yours, like, we generally with investors, we don't follow the grain, right? We don't follow the trends. A lot of times it's like, hey, when everyone else is, not being bullish, you need to be bullish, right? Or when they're sitting on the sidelines, like that's where the opportunity. So that's usually my recommendation to people is, when there's opportunity, you got to seize that, right? When everyone else is scared, you have to be aggressive. But I can say too that, and like you said, we could talk about this stuff all day long, but we've started to see a lot of people that have started to invest because they're tired of sitting for the past 2 years because they've let interest rates dictate their decision making, and they're like they have a little bit of optimism for 2024 just with the rumors or the Fed coming out saying, here's our anticipated 3 drops throughout the year, whatever the case. That's caused up quite a bit of activity. And lending certainly is different in the single family versus the multifamily and commercial space, because you can get a fixed loan for 30 years here, and you can refinance that fairly easily. And I own a lot of commercial. Most of my portfolio now is in commercial retail. And I can tell you, I bought some properties that I had a 3% interest rate on that was a 5-year term that now is due at a 6, right? And so that hurts, but time, to your point, time usually healed everything, but it is difficult to navigate those lending structures, because even though my rents have gone up and I've paid the loan down over the past 5 years on some of those commercial assets, their DSCR requirements still don't meet the bank. I got to bring more money to the table because the interest rate is double what it was previously. And so there are some people, there's a little bloodbath in people that may not be able to weather that storm, and could be some opportunity on the commercial side, as I'm sure you're aware. So
I think back to your point is a lot of headlines are in the single family because it hurts the everyday American, right? With the home and the roof over their head, the American dream. There is blood in the street right now in the commercial real estate world, and it is going on. There is great opportunities to be buying. It's just not in the headlines because it's not the American dream affecting the American dream. And I'll go on a soapbox and talk about that. Like it is happening today. And to your exact point, interest rates have doubled. Your values have come down. The DSCR doesn't work. What are you going to do, right? Can you bring more money to the table? Or if you have investors in the deal, do they even want to bring more money to the table? And that goes back to investor sentiment and are they confident? Again, whole podcast, we could literally talk about that right now. But I do think to what you're trying to say is, as I've been trying to tell people, it is a great time to be buying commercial real estate right now. Values are down between 20 and 30% across the country. Buy if you can, buy if you can, buy if you can. So it just, whether you're getting people to jump in with you is another thing.
Let me ask you this, Reed, because I've lost a lot of money in rental real estate. Thankfully, I've made more money than I've lost over the years, but I have not taken a year off of investing over the past probably 13 to 14 years of investing since I started. Every single year I've tried to buy real estate. And I think most successful investors that are still doing it for that long they're always trying to buy in any market cycle, given it. And like there's always opportunity. Like a big portion of what we do right now is we buy stuff and we do accelerated depreciation. We have an active business in real estate. We have a high tax bill we got to pay every single year. And like I will buy some of those low caps just for a tax write-off, right? Just to get depreciation. But I guess my question to you would be, do you think that the most successful investors consistently invest in any market cycle?
100%. Like one thing that I try to tell everyone is that you can never time in the market is better than timing the market, right? And so if you're deploying capital every single year over a 20 or 30-year period, you're going to win, right? Because you're going to have the better hits, the base hits, that is. Doesn't mean it's going to be 100%, right? No one will have a 100% hit rate. And I think we all know that, and we're seeing some of that right now in the commercial side, like what you just explained. But over the long term, deploying money every single year, you'll be just fine. Back to my point before is like the real estate is not a stock ticker, right? So pulling your money out when it's a little hairy is not, stay the course and hold. And the further you get away from the sort of the choppy waters, the better you'll be. And I think what I'm hearing from you is that we're starting to see some more normalcy, and maybe those choppy waters are starting to subside, because the last couple of years it's been really rocky. So with that being said, I like to get into the top 5 investing tips at the end of the show. Do you want to jump into it?
Let's do it.
Mate, question number 1 is, what's the daily habit you practice to keep on track towards your goals?
I wake up early. Yep. 5 a.m.
You work out?
I do every day. Yeah.
Love it, mate. Question number 2 is, who is the most influential person in your career to date?
Probably my father-in-law. He was one person that did just quick fire around. Quick story on him. Came from Vietnam. Sure, I was back. Escaped the war. Went to jail multiple times as they caught him. But came to Canada. My wife's Canadian, so he came over to Canada. Started multiple businesses. Couldn't speak English. Failed in those. Ultimately, later in life, in his 50s, got into multifamily real estate and small multifamily, and built a successful portfolio. And he's been a mentor to me as I've progressed our career.
That's awesome. Question number 3 is, what's the most influential tool in your business? When I say tool, it could be a physical tool like a phone or a journal, or it could be a piece of software that you just can't run the business without. What is it?
Oh man, I was going to go a little bit cliche and say people and communication.
Hey.
But to give a tangible asset walkway for people, I would say, just this small example on our short-term rentals, though, we've started to use dynamic pricing property. We've used Price Labs, which has made all the difference for actually dynamic pricing.
Price Labs. That's plural, PRICELABS?
Correct. Yeah. And that's dynamic pricing for short-term rentals. It doesn't have to be short-term rentals. It's just allows us to price our rents better for that geographic location, pulling data points from a lot of different places. And we've increased our income of like 20% on stuff. We own like higher end short-term rentals out in Colorado here and a little bit in the Southeast, but that's helped us increase our income over 20% just having dynamic pricing throughout the year.
Love it. No, I think that's, if you're running any real estate business, having dynamic pricing, it's actually taken from the hotel space where they have dynamic pricing based on demand. So for those people who don't know what that is, if your asset can afford it, definitely slap it on there, because it'll help you save a bunch of money rather than keeping your rents too high for too long and you miss out on a rent or whatever. It changes literally overnight. Question number 4 is, in one sentence, what's been the biggest failure and what did you learn from that failure?
Partnerships. And that would, I guess in one sentence, say we married someone before we dated them and we had to divorce them, cost millions of dollars. So, yeah.
We've all been through it. They are so valuable when they are done right. But I know I could again have a whole podcast about failed partnerships, and not necessarily they failed. It's just they come to the end of their use by date, right? And I think that's the biggest takeaway. You got to, on the positive side, I'm sure you wouldn't be where you are today without some of these partnerships, good, bad, or ugly. So, mate, last question: where can people reach you to continue the conversation that will be in your sphere? Where do they go?
Yeah, if you want to learn about market data, new construction, turnkey, whatever, I direct everyone to our website. We got a great podcast, YouTube channel, put a lot of things out there about all things real estate, talk about creative finance, seller finance, the 5% down investment loan. So that's renttoretirement.com. That's retirement.com. If you're listening in the car, you can text REI to 33777 and get on our dispo list, and we'd be happy to share all of our tools and resources with you.
Mate, I want to thank you so much for coming on the show today. Just want to share a little bit of the knowledge that I took away from today's show. I think you're such well-rounded in the approach to the specific niche that you're in, right? You talk about the election data cycles. I think that's really important. And it affects everyone's business. It doesn't just affect the turnkey guy or the multifamily guy or the self-storage guy or the starter mum and pop investor. It will affect everyone. And having a good grasp on that, you don't have to be an expert, it seems like you've really gone deep into that, and you're doing all. Definitely want to check you out on Bigger Pockets as well. But it has helped you become a better business owner in the long term. I do also like how you've transitioned from the smaller Section 8 stuff into better quality assets as you've grown as a business. I think that's a very key takeaway. And a lot of the people I speak to in the turnkey space, even in my space, you start with that sort of lower end product, the D plus, C minus, B plus, and you start working your way up the food chain as you become more experienced. And, having that laid out in front of us over the last, 10 or 12 years that you've been in business it's eye-opening and helps you become a better business owner. So did I leave anything out?
No, man, making me feel warm and fuzzy, Reed. What a great summary.
Well, mate, again, I want to thank you so much for taking some time out of your day. Enjoy the rest of your week, and we'll catch up very, very soon.
Thank you.
Well, there you have it. Another cracking episode jam-packed with some incredible advice from Zach. Remember, head over to renttoretirement.com. That's all spelled out RENTTORETIREMENT.com. He's got a bunch of stuff over there around getting into your first turnkey property. A lot of content out there. Definitely check him out. I want to thank you all for taking some time out of your busy day to tune in to continue to learn about your financial IQ, because it's all about what we're here on this show. The easiest way to give back to this show is to give it a 5-star review on iTunes. The show notes from today's show will be up on my website at reedgoossens.com. If you're interested in investing with us as well, check us out on reedgoossens.com. And we're going to do it all again next week. So remember, be bold, be brave, and go give life a crack.